Black Thursday, October 24th, 1929. I made $100 million that day, equivalent to nearly $1.5 billion today, while most investors lost everything. I didn't do it through luck or inside information. I did it by reading the market's warning signs that had been flashing for months. In the next 45 minutes, I'll teach you exactly how I spotted the greatest market crash in history before it happened, and how you can apply these same principles to protect yourself from the next inevitable collapse. I saw the signs 6 months earlier, when market volume began thinning despite rising prices. The smart money was quietly exiting while the public was still buying. Most traders focus only on price, a fatal mistake. I focus on the relationship between price and volume. When they diverge, something is wrong. By September 1929, I had already taken massive short positions. My brokers thought I was insane. "Jesse, you're fighting the whole country," they told me. But I wasn't fighting the market. I was listening to it. The market speaks to those willing to hear, not those desperate to believe. What I'm about to share isn't theory. It's the exact methodology that allowed me to profit while others jumped from windows. These principles have saved my fortune multiple times in 1907, 1929, and other crashes most traders never saw coming. I've made and lost several fortunes throughout my trading career. Each loss taught me something invaluable. My biggest losses came not from being wrong, but from being right too early and lacking the patience to wait for the market to prove me right. Timing is everything. The crash of 1929 wasn't a random event. It followed a predictable pattern I've seen repeat throughout history. Excessive speculation, margin debt at record levels, insiders selling while telling the public to buy, and the subtle warning signs in market internals that most traders ignore. I'll show you how to identify these patterns before they become obvious to everyone else. By the time headlines announce a crash, it's already too late. The real money is made by those who position themselves ahead of the crowd. My name is Jesse Livermore. I've been called the greatest trader who ever lived. I've made and lost more fortunes than most will see in 10 lifetimes. I don't share my methods to impress you. I share them because the principles of market behavior never change, even if the specifics do. The market will test you, deceive you, and try to separate you from your money. But if you understand its language, the language I've spent my life decoding, you'll have an edge few traders ever achieve. Let me show you how I read the signs before Black Thursday, and how you can apply these same principles to protect and grow your capital in any market condition. Let me tell you about the psychological foundation that made me the boy Plunger. My success wasn't built on complex algorithms or insider information. It was built on understanding myself first, then the market second. When I started as a 14-year-old quotation board boy in Boston, I quickly realized something profound. Numbers tell stories if you know how to listen. My psychological edge came from developing what I call tape reading, the ability to sense the market's direction by watching price movements. I didn't just see numbers. I felt the emotions behind them: fear, greed, panic, euphoria. They all leave footprints in the price action. The market taught me patience. Most traders lose because they can't sit still. I made my millions by waiting for what I call pivotal points, those rare moments when all conditions align perfectly. When I was absolutely certain, I would back my conviction with everything I had. That's how I made $3 million shorting the 1907 market crash in a single day. My psychological discipline had 3 pillars. First, I never argued with the tape. When I was wrong, I admitted it immediately and cut losses. Second, I traded only when conditions were right. I could stay out of the market for months. Third, I sized my positions based on conviction, not emotion or arbitrary rules. In 1923, I developed my line theory, tracking the market's path of least resistance. This wasn't technical analysis as you know it today. It was psychological analysis. I watched how stocks responded to news, noting which ones resisted downward pressure during market weakness. These resilient stocks became my targets when the market turned bullish. My greatest psychological strength? Emotional detachment. Money was never real to me. It was just points on a scoreboard. This allowed me to take enormous positions without fear clouding my judgment. When I lost my entire fortune, which happened several times, I rebuilt from scratch using the same principles. The hardest lesson I learned: psychological discipline must be maintained even in success. My worst mistakes came after my biggest wins, when overconfidence made me sloppy. Success breeds complacency, and complacency breeds failure. Remember this: trading isn't about being right. It's about being right at the right time, with the right position size, and with the right exit strategy. Master your psychology first, and the profits will follow. The market doesn't reward intelligence. It rewards psychological discipline and patience. That's the foundation that allowed me, a boy with no formal education, to become one of the greatest traders in history. Patience? It's the rarest commodity on Wall Street, and I've made millions by mastering it. When I was starting out in the bucket shops of Boston, I'd trade anything that moved. The result? I went broke, not once, but several times. The market took everything because I couldn't wait. Let me tell you how I transformed my approach. In 1907, during the banking panic, I saw the signs of collapse months before it happened. The market was weak, straining under its own weight. Most traders kept buying the dips, desperate for action. I stood back. I waited. For weeks, I did nothing but observe. Then, when J.P. Morgan failed to prop up the trust companies, I went short with everything I had. That patience earned me $3 million in a single day. The secret isn't complicated, but it's brutally difficult to execute. I wait for the perfect setup, when price action confirms my thesis and the risk-reward ratio is overwhelmingly in my favor. I call these pivotal points, and they occur rarely, perhaps 5 to 6 times a year at most. My rule is simple. I'd rather miss 1,000 opportunities than enter one bad trade. The amateur is always jumping in, afraid of missing moves. I've learned that the market will always provide another opportunity. Always. But capital, once lost, is gone forever. In 1929, before the great crash, I watched for months as the market made its final euphoric push. Speculators were borrowing at unprecedented levels. Companies with no earnings were commanding absurd valuations. The signs were there, but timing was everything. I waited until the market confirmed its reversal, then established my short positions. That patience turned $100 million in profit. Here's what I've learned about patience. It's not passive. I don't just sit on my hands. I study. I prepare. I rehearse my trades mentally. I know exactly what I'll do when the moment comes. I've already made the trade in my mind 100 times before committing real capital. The hardest part? Sitting through the dull periods. Most traders can't stand inactivity. They feel they must be doing something to justify their existence. That psychological need for action is what the market exploits. While they churn their accounts with meaningless trades, I conserve my capital and mental energy for the rare moments that matter. Remember this: the market doesn't reward activity, it rewards correctness. The big money isn't made in the buying and selling. The big money is made in the waiting. Master that, and you've mastered the hardest part of trading. Secret number 2 that I've lived by: emotional detachment. Trading without hope or fear. This principle has saved me millions, perhaps more than any other aspect of my approach. When I lost my fortune the first time in 1908, it wasn't poor analysis that destroyed me. My technical understanding was sound. What ruined me was my emotional attachment to positions. I hoped losing trades would recover. I feared missing opportunities. Both emotions poisoned my judgment. I've learned to view the market as completely impersonal. The tape doesn't know who you are. It doesn't care about your mortgage, your dreams, or your needs. The market is simply a reflection of all human fear and greed expressed through buying and selling, nothing more. In 1929, while others panicked during the crash, I maintained emotional detachment. I didn't gloat or celebrate as the market collapsed. I simply executed my strategy with mechanical precision. That's how I made $100 million, not by hoping or fearing, but by observing and acting. Let me be absolutely clear. Hope is a trader's worst enemy. When you're holding a losing position, hoping it will come back, you're not trading, you're gambling. I don't hope, I don't pray, I observe, I calculate, I act. Similarly, fear will paralyze you. Fear of missing out drives impulsive entries. Fear of loss prevents proper position sizing. Fear of being wrong keeps you in losing trades. I've purged these emotions from my trading process through brutal self-discipline. My method is clinical. I establish my parameters before entering any position. I determine my entry point, my stop loss, and my profit target before committing capital. Then I execute without hesitation. If the trade hits my stop, I exit immediately. No exceptions, no emotional overrides. During the panic of 1907, I watched as emotional traders were slaughtered. They pleaded with the market, they bargained, they froze in fear. Meanwhile, I executed my shorts with the emotional detachment of a surgeon. The result? I walked away with $1 million while they were ruined. Detachment doesn't mean I don't feel emotions. I'm human. But I've built systems to prevent emotions from affecting my trading decisions. I maintain distance between my identity and my trades. A loss isn't a personal failure. It's simply information. Remember this. The market will take every opportunity to exploit your emotional weaknesses. Your only defense is to develop the discipline to trade without hope or fear. This isn't natural. It requires deliberate practice and ruthless self-awareness. Master this principle, and you'll eliminate 90% of the mistakes that destroy most traders. Secret number 3 is the hardest to master: emotional discipline. In my 4 decades of trading, I've made and lost several fortunes, not because my analysis was wrong, but because my emotions betrayed me. The 1929 crash, I saw it coming, but even I wasn't immune to emotional mistakes during that period. Let me tell you exactly how I approach emotional discipline. First, I separate myself from my positions. When I enter a trade, I don't marry it. I've watched countless traders develop emotional attachments to stocks, refusing to sell when all signs point to disaster. In 1929, I shorted the market heavily, but I didn't let pride cloud my judgment when temporary rallies occurred. I maintained trading journals with brutal honesty. Every decision, every emotion, every mistake, I documented all. During the 1929 crash, I recorded my thought process daily, which allowed me to spot emotional patterns that would have otherwise remained invisible. When you see your emotions on paper, separated from the heat of the moment, you gain perspective no amount of market analysis can provide. I've developed a personal cooling-off period. When I feel excitement or fear rising, I step away, sometimes for hours, sometimes for days. In October 1929, while the market was in free fall, I forced myself to take walks along the Hudson River before making major decisions. This distance prevented panic selling at bottoms and overconfident buying during dead cat bounces. I never trade for excitement or to alleviate boredom. The market doesn't exist for your entertainment. I've watched traders destroy accounts because they needed the dopamine hit. During the quiet periods before the 1929 crash, many traders increased position sizes or traded questionable stocks simply because they couldn't stand doing nothing. I sat in cash for months, comfortable with boredom. I treat fear and greed as signals, not directors. When I feel excessive fear, I examine it. Is it rational or irrational? Same with greed. In 1929, my growing sense of unease wasn't anxiety. It was pattern recognition from decades of experience. Learn to distinguish between emotional noise and valid intuition. Finally, I accept that perfect emotional control is impossible. Instead of seeking perfection, I build systems to protect myself from my own psychology. My percentage-based stop losses and profit targets aren't just risk management. They're emotional guardrails that protect me from myself. Mastering emotional discipline isn't about eliminating emotions. It's about preventing them from controlling your decisions. This discipline saved me in 1929 and countless times since. The fourth secret that built my fortune was patience, a virtue I mastered during the most consequential period of my trading career. In the years leading up to the 1929 crash, patience became my greatest weapon. While others chased every market movement, I learned to wait in complete stillness. I developed what I call strategic inaction, the discipline to do nothing until the perfect moment arrives. From 1927 to 1929, I watched the market climb to dizzying heights. Everyone around me was buying frantically, consumed by the intoxication of easy profits. The papers celebrated new millionaires daily. My friends thought I'd lost my edge because I wasn't participating in the frenzy. But I wasn't idle. I was observing. I studied price patterns with religious devotion, noting how stocks would rise on decreasing volume, a dangerous sign few recognized. I tracked insider selling that accelerated while public buying increased. These divergences told me something monumental was brewing. My patience wasn't passive. It was predatory. I waited like a tiger in tall grass, conserving energy, while others exhausted themselves chasing every market twitch. When I finally acted in 1929, shorting the market before the crash, my account grew by millions while fortunes evaporated around me. Let me share 3 patience principles I developed during this period. First, distinguish between market noise and genuine opportunity. I trained myself to ignore 90% of market movements. They're meaningless oscillations designed to shake out weak hands. True opportunities announce themselves with specific patterns that I've documented meticulously. Second, embrace boredom as a competitive advantage. Most traders fail because they need constant action. They confuse activity with achievement. I've made more money sitting still than most make frantically trading. The market rewards those who can endure stretches of inactivity without compromising their discipline. Third, prepare psychologically for perfect execution. During waiting periods, I rehearsed my future actions obsessively. When the crash finally came, I executed flawlessly because I'd mentally practiced my response countless times. Your greatest trades should feel almost automatic, the culmination of patient preparation. Remember this: the market transfers money from the impatient to the patient. It punishes those who demand immediate gratification and rewards those who can defer it. In my 50 years of trading, I've never seen this principle violated. Your ability to wait without anxiety, to stand aside while others scramble, will determine your ultimate success. Patience isn't just about waiting. It's about waiting with perfect clarity, knowing exactly what you're waiting for. Master this discipline, and you'll join the elite few who extract consistent profits from the market's chaos. Risk management isn't just another trading principle. It's the bedrock of survival. After my spectacular crash in 1908, I learned the hardest lesson of my career. Preserving capital trumps making profits. When I lost everything that year, I wasn't just financially broken, I was mentally destroyed. I had to rebuild from scratch, and that experience forged my fifth secret: protect your capital at all costs. I developed a strict 10% rule that saved my fortune countless times. I never, and I mean never, risk more than 10% of my trading capital on a single position. When I violated this rule in 1908, the market punished me mercilessly. I lost $1 million in cotton, my entire fortune. The humiliation of returning to New York taught me that no trade is worth your entire capital base. Risk management requires brutal honesty about position sizing. In 1929, as I built my $100 million fortune shorting the market crash, I maintained strict discipline. Each position was mathematically calculated against my total capital. When other speculators were putting everything into the bull market, I kept powder dry. Their greed destroyed them. My caution saved me. I've developed a specific exit strategy that few traders understand. When a position moves against me by 10%, I exit immediately. No questions, no emotions, no second chances. This single rule has preserved more of my capital than any winning strategy I've ever employed. The math is simple but devastating. A 50% loss requires a 100% gain just to break even. I refuse to dig holes I can't climb out of. My risk management extends beyond individual trades. I segment my capital into 3 distinct buckets: 60% for core positions aligned with the primary trend, 30% for shorter-term opportunities, and 10% kept in reserve for extraordinary situations. This structure prevented me from overextending even in the most tempting markets. I've watched countless brilliant traders destroy themselves by ignoring proper risk controls. Intelligence means nothing without discipline. During the panic of 1907, I witnessed mathematical geniuses lose everything because they couldn't control position sizing. Their formulas were perfect, but their psychology was fatally flawed. Remember this: the market will always present another opportunity, but only if you have capital to seize it. I survived 3 major crashes and multiple personal bankruptcies because I learned to protect my capital base above all else. The greatest traders aren't those who make the most. They're those who lose the least when they're wrong. Secret number 6 is perhaps the most powerful of all my trading principles: reading market psychology. I've learned that markets are driven by human emotions, fear and greed, more than any economic indicator. By October 1929, I could feel the hysteria in the air. The market psychology had shifted to pure, unbridled greed, and I knew disaster was imminent. When I walked through Wall Street that autumn, I observed something crucial. Shoeshine boys and taxi drivers were giving stock tips. The elevator operator in my building proudly told me about his stock portfolio. This wasn't just anecdotal. It was the clearest signal of market top I'd ever witnessed. When everyone believes they're a market genius, catastrophe follows. I began shorting the market aggressively. My colleagues thought I'd lost my mind. "Jesse, you're fighting the tide," they warned. But I wasn't fighting the tide. I was anticipating its inevitable turn. Market psychology follows predictable patterns. First comes disbelief in a rally, then cautious participation, followed by conviction, and finally, blind euphoria. That final stage, when your barber is buying stocks on margin, that's when I position myself against the crowd. In the weeks before Black Thursday, I noticed trading volume increasing, while prices struggled to make new highs. This divergence told me the smart money was distributing shares to the public. The professionals were quietly exiting, while amateurs were piling in. I've developed a specific framework for reading crowd psychology. I track 4 key indicators: trading volume, public interest metrics, margin debt levels, and the quality of companies attracting investment. When speculation shifts from blue-chip stocks to questionable enterprises, that's my final warning sign. On October 24, 1929, the market crashed just as I'd anticipated. While others lost fortunes, I made $100 million in today's dollars by positioning against market psychology. I don't just trade charts or fundamentals, I trade human nature. Fear and greed never change. The same patterns repeat because human psychology is constant. When others are paralyzed by fear, I buy. When others are intoxicated with greed, I sell. My greatest advantage has always been emotional detachment. I don't feel what the crowd feels. I observe it, measure it, and position accordingly. This emotional independence is something you must develop to trade successfully. Remember, the crowd is usually right during the trend, but wrong at both ends. Learn to identify those turning points by studying not just price action, but the psychology driving it. Master this principle, and you'll have the most powerful edge possible in the markets. Patience isn't just a virtue in trading, it's a weapon. During the 1920s bull market, when everyone around me was frantically buying stocks, I made my greatest fortunes by simply waiting for the perfect setup, waiting for confirmation, waiting while others acted on impulse and emotion. The 1920s taught me that the market rewards the patient trader who can sit through periods of inaction. I watched as amateur speculators jumped at every ticker movement, while I waited for what I call the pivotal point, that moment when all conditions align perfectly. In 1924, I saw the market beginning to surge. Radio Corporation of America, Montgomery Ward, General Motors. These stocks were climbing daily. The newspapers trumpeted a new era of permanent prosperity. The public was intoxicated with stock speculation, but I didn't blindly follow. I waited. I developed a specific waiting discipline. I would identify my target stock, determine my entry point, and then, this is crucial, I would wait for the market to come to me. Not the other way around. I never chased prices. If the stock didn't hit my predetermined entry point, I simply didn't trade. Period. In 1927, I watched RCA for 3 months before entering. Others bought immediately as it began rising, but I waited until it consolidated and showed me the pattern I trusted. When I finally entered, I caught a move that netted me over $3 million. My patience paid for itself many times over. Here's what I've learned about the art of waiting. First, waiting is active, not passive. I'm constantly analyzing, preparing, and refining my plan while I wait. Second, waiting requires tremendous self-discipline. When everyone around you is making money, or appears to be, standing aside feels like torture. Third, waiting conserves your mental capital, your ability to think clearly when the real opportunity arrives. I developed a specific routine during waiting periods. I would review my trading journal, study price patterns, and rehearse my execution plan. This kept me sharp and prevented impulsive action. I also maintained what I call deliberate distance, physically removing myself from the ticker tape when necessary to avoid temptation. The hardest lesson of the 1920s bull market wasn't learning when to buy. It was learning when not to buy. I missed plenty of moves by waiting, but I avoided countless disasters. By 1929, my patience positioned me perfectly for the greatest trade of my life. Remember this: the market will always be there. Another opportunity will always come. But capital, once lost to impatience, is gone forever. Master the art of waiting, and you master a skill few traders ever develop. Secret number 5 is perhaps my most valuable discovery: emotional detachment. The market doesn't reward your feelings, it punishes them. In 1927, I watched countless traders swept away by euphoria, ignoring the signals I clearly saw. Their emotions blinded them to reality. I've made millions by maintaining emotional detachment. When I execute a trade, I feel nothing. No excitement, no fear, no greed, just calculated precision. This wasn't natural for me. I developed this discipline through painful losses. In my early days, I'd become attached to positions, refusing to exit when signals turned against me. Each emotional decision cost me dearly. Let me share exactly how I cultivate this detachment. First, I never celebrate wins or mourn losses. Each trade is simply information, neither good nor bad. When I made $3 million shorting the 1907 crash, I didn't throw a party. I analyzed what worked and moved forward. When I lost everything in 1915, I didn't despair. I studied my mistakes. Second, I trade only with capital I can afford to lose. Fear comes from overexposure. In 1927, I watched traders leverage their life savings, their homes, even borrowing from family. Their terror when markets turned was palpable. I never put myself in that position. My trading capital is separate from my living expenses always. Third, I follow my system religiously. Emotions tempt you to override your system, to hold longer, to average down, to chase losses. My system dictated I exit certain railroad stocks in early 1927 despite their continued rise. I executed without hesitation. Months later, when those same stocks collapsed, my capital remained intact. Fourth, I maintained physical distance from market hysteria. In 1927, I often retreated to my office away from the trading floor. The frenzy of the crowd is contagious. It impairs judgment. I review charts and data in solitude, making decisions based on patterns, not the panic or euphoria of others. Finally, I journal every trade decision with brutal honesty. When emotions influence a trade, I document it. This accountability forces me to confront weaknesses. After reviewing my 1927 trading journal, I identified 3 instances where subtle fear affected my position sizing. I corrected this immediately. Emotional detachment isn't about being cold, it's about being clinical. The surgeon cannot operate effectively if emotionally invested in every incision. Similarly, I cannot trade effectively if emotionally attached to every position. Master this detachment, and you've mastered a crucial element of market survival. Secret number 6 might be the most important principle I've ever developed: contrarian thinking. In early 1929, while everyone celebrated endless prosperity, I saw something different. The market had risen too far, too fast. The euphoria was palpable. Newspaper boys discussed stocks, shoeshine boys gave tips, and ordinary folks borrowed heavily to buy shares. That's when my internal alarm bells started ringing loudest. I've always found my greatest profits come from standing against the crowd. When everyone is buying, I look for reasons to sell. When everyone panics, I look for value. This isn't about being stubborn or different for its own sake. It's about recognizing that extreme consensus creates extreme opportunity. In the months before the 1929 crash, I methodically built my short positions while society ridiculed bears like me. I remember attending a dinner party where a prominent banker laughed at my caution, saying, "Livermore, you've lost your nerve." I simply smiled and continued my strategy. By October, my contrarian position had made me $100 million in today's currency. The courage to go against the crowd requires three specific elements. First, you must develop unwavering confidence in your analysis. I spent hours studying volume patterns that contradicted price movements, classic distribution signals as smart money quietly exited. Second, you must accept social isolation. Your friends will think you're wrong. Industry experts will mock you. The financial press will dismiss you. Third, you must have iron emotional discipline. Contrarian positions often move against you before they work. You'll question yourself repeatedly. I've developed a specific framework for contrarian thinking. I look for extreme sentiment readings. When investment newsletters show over 75% bullishness, I become cautious. When magazine covers universally praise a sector, I investigate shorting it. When taxi drivers offer stock tips, I prepare to exit. These are not just anecdotes. They're reliable indicators of market extremes. The hardest part isn't identifying contrarian opportunities. It's having the psychological strength to act on them. In 1929, I faced ridicule for months before vindication. Most traders can't tolerate this social pressure. They abandon sound positions to rejoin the comfortable consensus. Remember this: the crowd is usually right during the middle of a trend, but almost always wrong at extremes. The greatest fortunes in market history weren't made following conventional wisdom. They came from seeing what others couldn't and acting with conviction when others wouldn't. Contrarian thinking isn't just a strategy. It's the essence of what separates legendary traders from the forgotten majority. Secret number 7. Psychological resilience. Bouncing back from setbacks. The market will break you before it makes you. I've lost 4 fortunes in my lifetime, each one teaching me lessons worth more than the money itself. The 1929 crash wasn't just a market event. It was my ultimate test of psychological resilience. I made $100 million shorting the market in 1929, only to lose it all and more in the years that followed. Why? Because I violated my own trading rules and let emotions cloud my judgment. The market doesn't forgive such mistakes, and neither should you. Psychological resilience isn't just bouncing back. It's about maintaining your mental framework when everything collapses around you. During the 1929 crash, while others panicked, I remained methodical. I'd been preparing for that crash for months, positioning my trades precisely. My emotional state remained unchanged whether I was up millions or down millions. Here's what I learned about psychological resilience. First, accept that devastating losses are inevitable. The moment you accept this truth is the moment you gain power over the market. I've gone completely broke multiple times. Each time I started over with clearer vision. Second, develop a pre-loss strategy. Before entering any position, I ask myself, if this trade goes completely against me, how will I respond? This mental preparation prevents emotional decision-making during crises. Third, maintain physical discipline. During market turmoil, I follow strict routines, proper sleep, exercise, and nutrition. The body affects the mind more than most traders realize. During the 1929 crash, I maintained daily walks along Broadway, clearing my head while others were losing theirs. Fourth, isolate yourself from market hysteria. When newspapers screamed doom in October 1929, I disconnected completely. The collective panic of others creates opportunity for the disciplined trader. Finally, document your emotional states. After each significant loss, I write extensively about my mental processes. This creates objective distance between your trading self and your emotional self. The true test isn't how you perform during winning streaks. It's how quickly you reconstruct your psychological framework after devastation. After my worst losses, I've always returned stronger, more disciplined, and more dangerous to the market. Remember, the market will repeatedly test your psychological breaking point. Your resilience, your ability to maintain rational thought during chaos, will determine your longevity as a trader, more than any strategy or system ever could. The market broke me several times, but it never defeated me. That's the difference between a trader who survives and one who thrives. My psychological approach to trading has always been my greatest asset, more valuable than any single strategy or technique. After decades in the markets, I've come to understand that the battle isn't against the market, it's against yourself. Your own mind will be your greatest adversary, or your most powerful ally. I've taught you my methods for identifying trends, for cutting losses, for letting profits run. But none of these mechanical approaches will save you if your psychology is flawed. The market will find every weakness in your emotional armor and exploit it mercilessly. My greatest legacy isn't the millions I made. It's the psychological framework I developed that still works a century later. Markets change, technologies evolve, but human nature remains constant. Fear, greed, hope, and denial. These emotions ruled traders in my day, and they rule traders now. I mastered myself before I mastered the markets. When others panicked, I remained calm. When others chased trends blindly, I verified with cold analysis. When others held losing positions hoping for recovery, I cut my losses without hesitation. This psychological discipline is what separated me from the crowd. If I could leave you with one final lesson, it's this: develop a trading psychology that accepts reality exactly as it is, not as you wish it to be. The market doesn't care about your hopes, your needs, your theories, or your positions. It will do what it will do. Your only job is to recognize what's happening and respond appropriately. My success came from aligning myself with market reality, not fighting against it. I never argued with the tape. I never tried to impose my will on the market. I simply observed, analyzed, and acted accordingly. This humble approach, this willingness to be wrong and change course immediately, is what allowed me to survive and thrive. You now possess the core principles that guided me through bull markets and bear markets alike. Apply them with discipline and consistency. Remember that spectacular success doesn't come from spectacular actions. It comes from doing simple things correctly, over and over again. The market will test you. It will push you to your psychological limits. It will tempt you to abandon your rules when they're most crucial. But if you maintain the discipline I've outlined, if you control your emotions rather than letting them control you, you'll have an edge that few traders ever develop. This is my legacy to you. Not just methods, but mindset. Not just strategies, but psychological strength. Master these, and you master trading itself.